Hi everyone. We will welcome to the unbundling of the Union Budget 2022, hosted by Next Time in association with DBS. We shall begin in a few seconds. Hello everyone, and thank you for joining us today for the session Unbundling the Union Budget 2022, hosted by Next Time in association with DBS. Before we begin, please note that you are in listen-only mode. If you have any questions, please share them with us through the question box on the control panel. We will address your queries towards the end of the webinar or in writing if time does not permit us to cover them during our broadcast today. Union Budget 2022 provided a roadmap towards economic stability and growth. Finance Minister Nirmala Sitharaman presented the Union Budget, which focused on key infrastructural measures, inclusive growth, and sustainable development. The budget showcased strategic areas of growth. There was a strong focus on capital expenditure to set the foundation for India's growth over the next 25 years. The extension of PLI schemes, encouragement to digital banking and payments, as well as the introduction of the next phase of ease of doing business are just a few of the major reforms that were announced. With this background, let's move on to welcome the speakers joining us today. We have Ms. Radhika Rao, Mr. Maulik Doshi, and Mr. Saket Patavari. Radhika is the senior economist at DBS Bank Singapore. She has nearly 15 years of experience in the field of macroeconomics and financial markets research. She extensively covers the Indian economy markets, whilst also maintaining a keen interest in broader Asia and global developments to provide a holistic view to internal and external stakeholders. Welcome, Radhika. Maulik is the Deputy Managing Director, Tax at Next Time, with 2 decades of experience in the areas of transaction advisory, global tax, transfer pricing, and international tax services. He has assisted several multinational clients with inward investment advice, cross-border investment structuring, taxation of digital transactions, PEPS advisory, and expatriate tax matters. Welcome, Maulik. And Saket, who is the Executive Director, Indirect Tax at Next Time. He has 15 years of experience in indirect tax advisory, policy advocacy, and dispute resolution. He has headed indirect taxes for one of the largest telecom companies. He regularly addresses sessions and seminars organized by ICAI, CTC, NACIN, and CII on GST. Welcome, Saket. And now I would like to invite Radhika to shed some light on as to how does this budget fare on the Indian economy. Over to you, Radhika.
Thank you so much. While I take some time to just get my deck up. Hi, good afternoon, good evening, everyone. Thank you so much for joining us today. I think it's an important time this week, given the budget was just announced. And I think this budget in some ways really met expectations, and in some other ways, it surprised us. So what I hope to do with you is, to share some of our key takes. Certainly certain points that we raised here. I thought, before talking about the budget per se, let me just give you a bit of a background on what this budget was set against. My first part would be more to do with the backdrop, what is at present, because 2022 is certainly in many ways different from last year. So we'll give a bit of background before we talk about the budget proper. And again, instead of going through, fiscal deficit, revenues, expenditure as individual items, I thought we will try and address some very important questions which are being raised about the budget, right? So like the introduction did mention, any headline that you see about the budget has all been about the capex, but we also just take a quick dive into realizing if it is indeed so capex heavy as the numbers seem to suggest. So as a start, this year is certainly different from the last. what you do see is that last year, the same time, if you do recall, of course, in the past 2 years, it's been kind of a time blur, but the pandemic was still very much with us. We were facing the more virulent and transmissible variant, which was Delta variant. In India, the cases were just beginning to go up. Vaccination wasn't very broadly available, not only in India, globally as well. And this was certainly a very challenging time for the world. So that's why you had seen fiscal as well as monetary policy being very loose. And at the same time, inflation in most parts of the world was quite low because essentially there wasn't much demand, and hence even commodity prices were much more manageable levels. Now, fast forward to this year, what you do see is that many things have changed on their head, right? The pandemic, again, still with us, but thankfully the latest variant seems to be much more transmissible but less virulent, and it's also that hence it's allowing for restrictions to be broadly minimal or localized. At the same time, vaccination has reached many parts of the world. In some parts, the third booster shot has already been given, one or two boast of giving the fourth shot as well. Nonetheless, we feel much more confident about facing the pandemic than we had done earlier. Hopefully, time will tell us that we're right in this assumption. While this is going on, inflation is really stepped up, particularly in the West. They haven't experienced inflation in a very long time. And that's why, as a follow-up, you do see monetary and fiscal policies are beginning to tighten. Now, why is all of this relevant for our budget? I think we should see this from the lens of most of the governments now are wanting to firstly consolidate, and secondly, not be very keen to indulge in fiscal activism, that is essentially spending a lot more to safeguard growth. Now, with this backdrop, when I do discuss the budget numbers, first of all, let's get the basics out of the way. What was the fiscal deficit target? I'm sure you've been through this in the past few days. So there was consolidation, but more modest than markets had expected. The budget does expect all the revenues this year. When I say this year, I mean fiscal 23, which is going to start soon. All the revenue heads to do better, direct as well as indirect. Barring a couple, excise duties because of the oil cut, the collections are expected to be lower, and divestment as well. And I would think that single-handedly this was a big surprise because they did, after adamantly keeping it above 1 lakh crore for a few years, now the target has been set at a much lower level. In fact, now it's been criticized for being too conservative. But I think this is a better place to be in, because if there is any way, it's going to be up in terms of surprises. And finally, on expenditure, we don't see a huge difference between last year and this year. Now, this is expenditure at the aggregate level, total expenditure. If you remove the interest payments, expenditure is broadly, only slightly higher than last year revised estimates. Now, with this in mind, let me then start addressing the questions. Firstly, I try to answer, are the budget assumptions credible? When I look at growth, I do think that it's more realistic. In fiscal 22, we had the tailwind of a 3% surprise or cushion in terms of the growth, growth number. It was at 4.4% budgeted. The actual is going to be upwards of 17%, right? In fiscal 23 as well, we do think that there is at least and at best case 1.5% cushion on the growth front. So how does that help? Because most of your revenue, your expenditure, fiscal, everything is taken as a percentage of GDP. So the better it is, the better your numbers look in terms of a ratio. Revenues, buoyancy that has been assumed, direct tax numbers that have been assumed are still very, very conservative to being realistic. In fact, even for fiscal 22, we do think the numbers are finally going to look much better. That means the fiscal 22 number that they have come out with in terms of deficit could be narrower than what has been budgeted. Thirdly, fiscal deficit, like I mentioned, because revenues are looking conservative, because the expenses that have been factored in might not be all spent, we think overall there is room for fiscal deficits to over-deliver, to mean that the actual deficit would be narrower in fiscal 22 as well as fiscal 23. Second question, and I think this is perhaps the most important, that the capex spending that have been mentioned in the budget, do we think it's for real? Right. I think the first reaction to this is that it's extremely strong, and rightfully so. It also means that the government is trying to go the supply route in terms of taking action on spending rather than the demand route by just giving short-term impulses. So just for some numbers, I mean, it's a record increase or record at the nominal, at the absolute level. It's a twofold increase if you were to compare pre-pandemic levels. And where is all this money going? Part of it is going to roads, some of it defense, railways. We also need to remember that from the aggregate, it's also going to states. I think rightfully so, again, because they are the ones who are closer to the ground. They're the ones who spend on, say, urban infrastructure, responsible for education, health, and all of that. So it's good to leave some more cash on their hands. And the third thing that they've done, which is again a carry forward from last year, is to take more obligations onto the books so that you can get a true reflection of overall spending. Then that leaves us with the final question. Yes, capex money has been put aside. Will all that be spent? So the intent is certainly very important, and I think that's headed in the right direction. Absorption capacity based on the past, there could be some hindrances in spending all of the money that has been allocated. I also want to remind everyone or recall that, if the government spends 100 rupees, less than 20 rupees is going into capex, right? So the 80 is still revenue expenditure by way of, say, subsidies, interest payments, and salaries and pensions and all of that. So that is the sticky bit. But in terms of capex, we would be very excited if, even 60-70% of the budgeted numbers are spent, which essentially means that there'll be higher multipliers for growth. So we wouldn't bet on all of the money being spent. Again, like I said, you have to adjust it for these, NHAI kind of off-the-book financing. You have to also account for what has been given to states, and the amount that's left. We would be, I think, very encouraged if it is about 60-70% of that amount. So yes, headed in the right direction, good allocation, but we do think that not all of it might be spent. And what that does then is to leave us with some room in case, say, things like allocations to Manrega needs to be raised, or to subsidies need to be raised because of higher commodity prices. So there is still that room for the rejig in spending items. The third question is, again, it was a very supply side response. What is happening on the demand end? So the kind of list that you saw in the measures, it seems to suggest that instead of giving money out, in cash or in terms of kind, what the strategy seems to be is to depend on the trickle-down effects. So hence, you've seen sectors like affordable housing, MSME, agriculture get some focus, because these are labor-intensive by nature. And also support given to them is by way of higher allocations or by funding, in terms of credit guarantees. And the hope is that if they do well, they are able in a shape to employ more, and that will then result in permanent income improvements, rather than you were to give some handout and then that would fade, particularly in 3, 6, 8 months. And we should also remember that the environment overall is still quite cautious, so there will be a tendency to save that rather than to spend. So you might not really see that consumption pick up as well. On the right, I've just given some of the main schemes. As I said, allocations are lower, but in the event that they see a need to increase, I think there is sufficient room to rejig in terms of the priorities. Fourth, apart from those traditional parts, what are the other ones that you have seen? You've seen new priorities being outlined. You've seen the green bond issuance. Now, since the announcement was done, we have heard quite a few queries on what is the green bond issuance about, how keen is the government on pursuing this, what will be the size, what will be the scope. So from what we understand, we have really no idea about the what quantum it would be, but it could be around, say, 1 lakh crore. It would be rupee securities, but of course, in what shape whether it's going to be just onshore or it is going to be, much like masala bond, which is rupee securities, but also available offshore. So that those are clarities that are still awaited. But nonetheless, non-sovereign players have been very active, Indian players as well, finance and non-finance companies, in raising much of these green bonds offshore. And there have been a few who have done it onshore. So if I were to see the non-sovereign space, that's the private bond issuance, they've been much more active on the offshore arena. So these are some of the other priorities that were outlined. I don't want to go into each of them in the interest of time. One absent measure was the capital gains rationalization. This is to do with the bond index infusion. This was certainly a disappointment, but what I wanted to add here is that this does not mean that India's bonds will not be taken on to the global bond indices. It's still, because Euroclear is necessary, but not a strict prerequisite. Many of the bond indices do take on securities. I give you an example of Indonesian bonds, for example, which are not Euroclear, but and it's a part of the index, and hence foreign investors have bought into it in the past. Quickly, budget is going to be an event which will be looked at by the central bank, because central bank meets in 4-5 days time. What will they do about what just happened in the budget? We think they will reiterate the fact that bond markets, yields, all of that is a public good. It should evolve in a properly fashion. So, and they stand by it. We do hope that the verbal assurance is also followed by action as well. In terms of policy normalization, we expect the central bank to hike rates in the second half of the year, but we do see a risk that it will be brought forward. And that's primarily because many of the global central banks are also doing a quick one because of inflation as well as liquidity worries. Let me then go on to the last couple of slides of mine. In terms of market implications for FX, for rupee, we think it's a non-event. But for rates, it's really been a dire response since the budget was announced. Because of the high borrowings, the rates have really jumped quite strongly. So we are very keenly watching for what the central bank would end up doing, because they really need to show their hand to try and stabilize the very sharp increase in yields. There are certain pockets of the market that don't think they're going to come in as yet, that if 10-year breaches 7.2% is when they would come in to do some ad hoc support. So in summary, there is sufficient room, like I mentioned, for fiscal outperformance. There is cushion on the growth front in terms of revenues as well. And also considering that not all which has been allocated for spending might be spent. Of course, the center is hoping for the private sector to join in soon. And we do hope that the private sector sees sufficient demand in terms of demand visibility to follow the central government's cues. And finally, consolidation needs to remain on track because our debt levels are very high to begin with. So first of all, even if it's a modest pace, that will be very helpful. And over time, it will at least help us get to, say, mid-80s as a percentage of GDP by 7-8 years' time. With this, I'll conclude my part. Happy to take questions towards the end of the presentation, and I pass it back to our partners.
Thank you, Radhika, for your valuable insights. You summed it all up well. Before we move ahead, I would like to request our listeners to add any questions they have in the question box. We shall take them up at the end of the session. I now invite the tax specialists, Maulik and Saket, to share their views on some of the tax announcements made and how they would impact businesses. Over to you, Maulik.
Thank you. Good afternoon to everyone. I think with an excellent overview of the economy picture, the macroeconomic picture that Radhika gave, I'll straightway jump into on the direct tax side. And year on year, I always make this statement that at least the last few years, we are seeing budget becoming a little bit of a non-event from a tax perspective. In fact, the year 2019 and year 2020, we saw significant amount of developments outside the budget than within the budget. So in that sense, for us, it's more like a daily job now. But yes, there are always some surprises. There are always some changes in the budget, and there are a lot of expectations being built either to correct the anomalies that are there or to kind of give a boost to a particular industry or a sector. And that's where the direction from the budget is becoming visible. In terms of the current year's budget, the government has done nothing in terms of tinkering with any of the properly laid down proposals, and kind of the policy that was formulated by the government in terms of tax reforms, less litigation, they're just continuing to step forward on that. The lesser number of amendments, in fact, I think one of the years where we have a very less number of amendments in direct tax, really shows the consistency with the government wants to go ahead and kind of the path at which the government wants to move forward. From a tax perspective, the message on the tax proposals was very clear. They're still looking at facilitating compliance, trusting the taxpayer, and kind of reducing the litigation. I think that's the message that is coming out from the overall tax changes that are there in the budget, and we will kind of deal with it in some details over the next few slides. I'm not going to go into the macroeconomic picture now, given that Radhika has already kind of given us an overview. So I'll straightway jump into the tax changes. Like I mentioned, no changes in the tax rates, either for personal, individual tax rates, no slab rate changes, etc. Neither there is any change in the corporate tax rate. However, they did kind of clear the anomaly or imbalance that was there with respect to cooperative society taxation, where the earlier alternate minimum tax was 18.5%. They brought it down to 15% in line with the corporate tax. Same with the surcharge for income ranging between 10 million to 100 million. They brought it down from 12% to 7%, again, in line with what is there in the for companies. So it was more like a course correction. The cooperative society possibly didn't get the attention earlier. Now it's been getting corrected. One change in terms of the tax rate was on surcharge on long-term capital gains. Earlier listed securities were kind of the surcharge was capped at 15% irrespective of your level of income. Now, and for the other assets, for other than listed equities, it was as high as 37% in the top bracket. Now the surcharge has been restricted to 15% for all asset classes. And therefore, if you are in the top bracket, the long-term capital gains used to be 28.5%, now comes to just below 24%. So to that extent, there's a significant relief in terms of the overall tax rate for long-term capital gains. The other change that the government announced on the individual tax side is mainly COVID-related tax exemption. This was also announced prior to the budget. It was only being brought into the budget to kind of bring it on the statute. So any amount received by an individual for medical expenses of self or family, it's not at all taxable. So this basically was to help individuals who are receiving money from either employers or even through crowdfunding or through relatives, anywhere. If this provision was not introduced, the amount would have been taxable in the hands of the individual, and it would have added to the misery. So in that sense, it's a welcome move and a very thoughtful move by the government. Same way, any ex gratia amount received by a family member of a deceased person because of COVID-19 related diseases, that would not be taxable if it's received from the employer. There is no limit on it. And up to 10 lakhs, 1 million rupee if it's received from any other person. So kind of providing a relief to really what was needed. And this, like I mentioned, was announced, I think, May of 2021, is just brought into the statute books now. For the corporates, again, no change in the corporate tax rate. It remains as it is. The government did overhaul the corporate tax regime a couple of years back in 2019, when it brought down the new manufacturing companies tax rate to 15%, when it brought down the overall tax rate to 22%. So from that perspective, there is no change, and neither was one expected. The couple of changes on the corporate tax side are, one is there was a concessional tax of 15% for Indian companies having foreign subsidiaries and receiving dividends from the foreign subsidiaries. That 15% corporate, the concessional tax rate is now been withdrawn from 1st April 22. So to that extent, kind of this slightly I'm not able to understand the implication of it. It was to encourage Indian companies to bring back accumulated profits back in India. With the change in the tax rate and bringing it in line with your normal corporate taxes and increasing the burden, I think the government is trying to signal that there is no need for Indian companies to really bring in the money. But at the same time, there is a small window available till 31st of March 2022. Companies who are really looking at bringing in accumulated profits from their subsidiaries abroad can look at this window and under the concessional tax regime itself. There was a concessional tax regime for new manufacturing companies that was announced in 2019, where if one of the condition was that the new companies that are set up for manufacturing, they need to commence manufacturing before 31st of March 2023. Because of pandemic and the fact that there was the private sector did delay their investment decisions and the time that was lost on account of pandemic, this is been extended by 1 year to 31st March 2024. So if you are looking at starting up a manufacturing and making new investments, you can kind of do, if you start off your manufacturing process before 31st of March 2024, you can enjoy a 15% tax rate for the rest of your life. Same way for startups, they were kind of the startups that enjoyed a tax exemption for 3 years in a 10-year period. One of the condition was that they need to be incorporated before 31st March 2022. That's also been extended by 1 year to 31st of March 2023. So essentially, these were also on the lines that was expected because of COVID, people were really expecting this extension. Certain clarifications that the government has provided, especially on business reorganizations. A lot of companies do restructure their operations and restructure their structure, their holding structure. Many companies opt for mergers, demergers, amalgamations within the group. The government did notice that there is a significant time lag between the time a company makes actually an application for merger and the merger getting effective and court order being received. And there was always a confusion in terms of what happens in the intervening period. Do I kind of file tax returns as a successor entity? Is the tax demand on the previous entity automatically passed on to successor entity? So a lot of this confusion was there. Now the government has provided that during the pendency of approval, proceedings, even if they were made on the earlier entity, would now be kind of presumed to be made on successor entity. So there is no kind of gap there, and it kind of continues in a smooth manner. They also provided a time frame of 6 months after the merger, after the court order, to enable the companies to file a modified tax return by the successor entity, so that kind of whatever effects are to be given on account of merger are properly given on the expense deductions and tax deductible items. I think the government has made few clarifications. These are again overruling some of the court rulings, and the idea is that the government would want to clarify their intention in terms of what was the intention of drafting the legislation, and possibly it was not rightly interpreted by courts and taxpayers. One such is the surcharge and cess is no longer a tax deductible item. Since the education cess was introduced in 2005, many companies were taking a position that this is not really in the nature of tax, because this is being collected by the government for a specific purpose to meet the secondary education and healthcare objective of the government. And therefore, rather than going into the common kitty of the government in terms of tax, it is for a specific purpose and therefore cannot be regarded as tax. And therefore, I should get a tax deduction on account of this. This was also kind of upheld by a couple of high courts. Bombay High Court and Rajasthan High Court did upheld this ruling. But now the government has said that that was never the intention. The Bombay High Court and Rajasthan High Court that gave the ruling unfortunately didn't consider an earlier Supreme Court decision, which was always clarifying the position very clearly. And therefore, to that extent, the rulings are also not in line with the law of the land, which was clarified by Supreme Court. Now the government has made it absolutely clear by providing it in the law. So one is obviously no longer you can claim the cess as a tax deduction item. But for the past years, because this is brought with a retrospective effect from the day when the cess was introduced. So for the past years also, even if you got such a relief, that relief would now be reversed through some proceedings by the government. The only saving part, I think, would be the penalty would not be levied on account of this because the companies would have taken this position based on a high court ruling. Similarly, there was a provision which disallowed any expense incurred in order to earn exempt income. Various court had taken a position that such an exempt income should actually be earned by the company and not merely because there is a possibility to earn exempt income. The government has clarified that that was never the intention. As long as the expense is correlated to earning, to kind of make an investment or to bring an asset class which is going to earn an exempt income, that expenditure should be disallowed, irrespective of whether the fact that exempt income is earned during the year or it's more futuristic. So again, this, like I mentioned, is brought in to overrule some of the favorable court rulings. But again, clarifying the position from the government. This is again more academic because now pretty much with dividend getting taxed in the hands of shareholders, there are hardly any exempt incomes that are remaining, and therefore really in practice going forward, the effect would be hardly anything. The government also brought in one specific clarification that any expenditure incurred which is in prohibition or under the law, which is for kind of to benefit a person which is also violating a law or which is compounding an offense which is again violating a law in India or outside India, such an expenditure would not be allowed. So there was a question that whether a particular expenditure would be allowed, and there was earlier a decision that certain FEMA compounding fees or SEBI compounding fees, etc., paid, whether they should be allowed as a tax deductible item. The government has now made it very clear that this would not be allowed. There is an unintended issue in this, that if an Indian company, for example, is paying any settlement fees, say in a court abroad, which is not really in some sense a violation of a particular law, but in order to buy peace, they are settling a particular suit that is being filed against them. Like we hear a lot of Indian IT companies settling matters in US courts on account of immigration violations, etc. So those kind of things also would be disallowed now as per this amendment, because in some sense there would be a violation of the law of which is outside India. But the government has now made it very, very clear that this is what they intend to do. The most important aspect that they have brought in is on the taxation of digital assets, cryptocurrencies, as we kind of want to call it, although the definition of digital asset as they have defined is very wide, which includes not only cryptocurrencies, but also NFTs. The government has clarified that this would be treated as an income, and transfer of a digital asset would be taxed at straight 30% plus the applicable surcharges and cess. So you cannot take a position that this was capital gains long term, therefore I'll tax it at 20%. This is straight 30% taxation. You will not get any deduction at all of any expenses while computing. If there is a loss arising from digital asset, it cannot be set off against any other form of income. It cannot be carried forward. So whatever is the income profit during the year, you straight pay 30% on that. In order to ensure that there is compliance and there is reporting, a TDS of 1% has been introduced, where the person responsible for payment to resident towards the purchase consideration of this virtual digital asset would have to deduct tax at 1% and pay it to the government. And they also brought in gift of such a virtual digital asset to be taxed in the hands of recipients. So they've kind of, in some sense, created a separate code for taxation of virtual digital assets. The only thing that remains to be seen is that what happens of such a cryptocurrency or NFT under the GST law, because that is still something where the government has not clarified anything. But this would obviously add a lot of compliances, especially for crypto exchanges and wallets that would be really making payments to individuals. There would be kind of a issue in terms of double taxation if there are gifting of virtual digital assets. And the most important question I think that the government clarified through several press conferences is that this in no way legalizes the crypto transactions or legalizes the cryptocurrencies. The government has made it amply clear. And the Indian tax law was that from years to come, that as long as you are earning income, whether legal or illegal, whether it's from smuggling or it's from your normal business income, the government is going to tax that. The taxing of income does not give the backing of legality to the transaction. The government also provided certain exemptions to IFFC. Mainly, the IFFC has been the core agenda of the government, and they have been kind of looking at that provisions, and they are extending that kind of a benefits year on year basis as and when they realize that particular aspect is missed out in IFFC. So they more specifically, they have kind of provided that if a unit in IFFC is receiving any income on account of portfolio management services with respect to management of an overseas portfolio, that would now not be taxed. And they've kind of added on to leasing of ships and transfer of ships if it's being derived by a unit of IFFC further. So again, more incentives, expanding the incentives bracket for IFFC. Certain changes on the procedural side in terms of withholding taxes. Again, nothing that is of more significance, but one particular point that I wanted to take up is that now there's a withholding tax or a TDS being introduced on any benefit or perquisite given to business associates if the benefit or perquisite is more than 20,000 rupees in a year. This typically refers to payments made by several FFCG companies or pharma companies to their dealers, distributors, agents. We kind of hear that overseas trips are being kind of sponsored by the companies if the dealer achieves a particular target. All of that would be coming under this net. This amount or the benefit was always taxable till now. Again, there was no reporting and no one was kind of offering this income to tax. Now they've kind of provided that there's a TDS of 10% to be done by the company so that it gets reported and the recipient would be compulsorily have to report that in his tax return. So this is something which is of significance. And lastly, the government has kind of provided an updated tax return scheme, which is more like if a taxpayer realizes as an afterthought that he has missed out reporting a particular income, or based on certain information that is being provided by the tax department, he genuinely feels that, okay, I have missed out, then he can update his tax returns up to 3 years from the end of the financial year. If he updates the tax return up to 2 years, he has to pay an additional tax of 25% on the aggregate of original tax and interest. And if he updates the tax return between second and third year, he has to pay almost up to 50% of additional tax. So this is over and above the normal taxes, and the effective tax rate could go as high up to 60-65% if you look at updating the tax return between second and third year. Obviously, there are certain non-eligible items, like if the government has already detected that and issued a notice, you cannot go under that. If there are circumstances like search, survey, raid, etc., you cannot go under this thing. So this has to be more like a mechanism where the taxpayer realizes as an afterthought that he has missed out something. The scheme is open to him to look at that part. So these are some of the key changes. I really don't want to get into the details of others, which are not really so relevant. I would now pass it on to Saket to kind of take up the indirect tax part. And post that, if there are any questions, we can look at both all the questions together. Over to you, Saket.
Good afternoon, everyone. Good afternoon, everyone. From an indirect tax point of view, let me just share my screen. So in an indirect tax, we'll discuss about there are 4 laws. There are 4 laws that gets impacted in the budget. One is GST, customs, and then excise and SEZ law. Some announcement on the SEZ law. Now, coming to GST. GST obviously it's now after 2017 when it was introduced. It's state and center. So all the major items or major rate changes, etc., come from the GST Council, not in the budgets. In the budget, however, there are critical and important procedural requirements, operational matters, as well as some legislative changes that come about in the budget. Even in this budget, we saw a few of the changes, some benevolent, some really rigorous one. This is the one which is a bit more benevolent for every, but more at an operational level. What they have extended the timeline for availing that input tax credit. Earlier, it was till September. 30th September, you filed your return by 20th of October, you could have taken credit for the last financial year only up to that. If you miss that deadline, then the credit is lost forever. They extended it to 30th November, aligning with the TP filings and the income tax filing finalization of their financial accounts. So they've aligned it to and increased it by 40 days. They've reduced the time limit for payment of non-resident taxable persons taking registration in India for some supplies that they were undertaking, because they are anyway not entitled to take credit. So why to have a higher time limit of 20th of subsequent month? They have reduced it to 13th of subsequent month. Apart from that, one minor change for UNO, that's more of course correction. They were required to, for their, for refunds, they were required to do it in 6 months. They've increased to 2 years. This is the hallmark of the budget, has been on the stringent compliances. Like every year, they want to increase the compliances, or they want to make compliances more. Even in this budget, they have done so. Now, the restriction is, if you don't file your GSTR1 return, wherein you report all your invoice level reportings or transactions on the GSTN portal, if you don't do it, you cannot make payment of tax under GSTR3B on 20th of the month. And if for the past period you have not filed your GSTR1, you cannot file for the subsequent month. So what the government is trying to say is, everyone is supposed to, the taxpayers are supposed to comply with the filing of returns month on month, and should not be any break in that. So apart from that, and we'll discuss a bit more on the stringency of, how will this provision apply, or how would this change apply in a scenario of credits at the customer's end. We'll discuss in a moment. That's more rigorous in the compliance front. Second change that they have done is, last year, or maybe about more than 1.5 years back, they brought down a provision wherein they say a credit that you have can be restricted to a 99%. That is 1% you have to pay in tax, only for a very limited category. It was mostly a way to plug fly-by-night operators who would, only pass on credits and do not pay any tax out of cash. So just to curb that, or to identify them, they had done it, but it did not have a legal backing, which they have done by introducing a provision in this budget. Otherwise, this would have been considered to be beyond the statutory powers. Apart from that, some late fee on the TCS return. And then if there is, they've introduced a section which allows for your all your refunds. Earlier, only export and inverted duty structure refunds could be attached if there is a demand. Now they've expanded to all the other kind of refunds that you are entitled to get. They can attach it if there is any demand. Now, from a credit restrictions point of view, one, they have said that there are two main criteria for you to take credit, apart from others that is in your hand. The two main criteria which is dependent on your vendor is, he should comply by filing his return, that is transaction level reporting on the GST portal. Second, he should make the payment of taxes. If any of these two things he doesn't do, then as a recipient, my credit gets jeopardized. And in the recently, about a month ago, when the credit will be barred because of GSTR 2B returns that has come out, or 2B filings. Now, what they now have introduced a provision which says, if you have taken such credit, you have to reverse it as a customer, as a recipient of credit, you have to reverse it with interest. Okay. Now, that's one of the provisions. So enabling provision has been brought out, wherein you have to pay the tax if they reverse the credit, or pay the tax or credit if your vendor or your supplier does not comply with the tax laws. Apart from that, what they have brought down in this budget, which is most rigorous, is they have given powers to the central government to make rules to further restrict the eligibility of credit. Not only restrict the eligibility of credit, but also hitherto the power or the decision making or the umpire for the credit is now GSTN, or the GSTR 2B return that gets reflected in GSTR. Hitherto, we used to take credit on our own, and if it did not match with what is reflected in GSTR 2B or 2A in the GSTN portal, the government, the tax authorities used to come to us and ask for details, clarification, etc., for which we provided the clarification. But so far, I was entitled to my credit. I had the discretion to take my credit, and that has been the self-assessment regime since last 25 years, or maybe since 35 years since the modified scheme had come. Now they are restricting it. What they are saying is, the GSTR 2B return which is the filing from all the taxpayers and the GST payments by vendors, that is the sacrosanct data, and you are supposed to take credit basis that. Not only that, the two restrictions that I spoke about some time back, they are adding few more restrictions to it. and which means it's not only these two criteria that the vendor has to follow. Vendor has to follow all the other criteria, and if any of these compliance error, inaccurate compliance or a conduct at the vendor's end, if there is any misconduct or any error at the vendor's end, then me as a customer, credit can be denied. One is, if the vendor's output tax liability reflected in his invoice-wise reporting in GSTR 1 is greater than actual payment of tax reflected in GSTR 3B, my credit as recipient for that vendor gets restricted. If the vendor has taken excess credit, then what is reflected in GSTR 2B, then as a customer, my credit gets restricted. Now, suppose still I take this credit, okay, then for my customers, that is the customer takes credit for customer's customer, the customer becomes a defaulter and the customer's customer credit also get in jeopardy or gets restricted. Now, all these restrictions will be in the GSTR 2B return. They are supposed to provide all such kind of restricted credit also, which means you cannot take these credits. And this also includes if a vendor does not comply or does not pay tax for a continuous period and that will be prescribed, then my credit gets restricted. Other than this, if the utilization of credit is more than, we just saw a rule where it provided 99% of utilization. If the utilization of credit is more than what is mandated, then also the customer's credit gets restricted. And last but not the least, for new suppliers, someone who's registered newly in the GSTN portal, they may have a provision to restrict the credit for a certain period of time. Now, for those players, people who are newly in the business or newly set up business, it will be a crunchy situation or cash flow situation, because what will happen is the customer will not pay the tax because he's not getting the credit. So his cash flow, but he has to pay the tax in compliance. If he doesn't pay, then anyway customer does not get the credit and he becomes a defaulter. So he'll have to anyway pay the tax. So he'll have to have, fund that tax payment, which he could have recovered from the customer until and unless he is allowed that amount to be taken as credit. So these are rigorous provisions. We have to see the rules to what extent and where it applies. Given the current scheme of things, it's very widely worded. If it applies all across, then certainly we're going to see few things. We're going to see a host of litigation coming up between the vendor and the customer, because customer's credit gets denied. Then he'll be disputing with the vendor, and vendor would say, look, what do? I have done everything, but still your GSTN portal or the government portal is saying something which is different. So then there is a dispute with the government. So there are tripartite dispute will start between the vendor and the customer, and vendor and the customer and the GST portal or the government. So which would be obviously, which will shoot up the litigation, and not only, and it will certainly, it is something which is not in line with the government philosophy of ease of doing business. We'll have to only see how this goes on. Hopefully they'll restrict it like 86B, where they've restricted only to a very small category, because the idea is to prevent frauds. Hopefully they restrict it to a very smaller category of taxpayers, not to all. Apart from that, some facilitation measures. If you pay tax in cash on the GST portal and you realize there is that you have paid in the wrong state, earlier you had to only go and take a refund of it. Only within the same state, within different categories of tax, CGST, SGST, you could transfer the money. Now, if you have paid tax in one state, but then you realize that the cash tax payment is required in another state, then you can transfer it now. That's a good facilitation measure. Another retrospective change that they have done, which is benevolent, is if you have taken the credit and availed and utilized it, then only interest applies. Otherwise, interest does not apply. And that too, interest rate is 18%, not 24%. Otherwise, the position, it was so vaguely worded, position was people were taking 24% of tax. Now it's only 18%. They have clarified retrospectively. If someone has paid tax between 24%, then 6% can be claimed as refund. We'll have to see the limitation period. Within 2 years, you can file a refund. Even if you breach 2-year period, to my mind, you can still claim a refund because it's an unauthorized tax, unauthorized interest that they've been collected. But certainly it will be subject to litigation, and you may have to go to the High Court to get this refund. Apart from that, some procedural changes or some redundancies of GSTR two-way communication that was envisaged when the GST was launched. but they've realized that through technology solution, yet it's not possible, and they've given up on this, which they have made in the law, that two-way communication between vendor and customer for matching of credit is no longer needed. Apart from this, on the customs front, one legislative change, the customs authorities or the DRI authorities who looked at smuggling, who looked at tax frauds. Recently, the Supreme Court, or not recently, about more than a year ago, Supreme Court in Cannon's case and Agarwal Metals case had said that DRI authorities do not have the power to undertake the proceedings of adjudication, show cause notice, etc., which resulted in all such taxpayers or all such notices outside, get scot-free, which the government has corrected by way of a retrospective amendment. And apart from that, what the government has also done, they've accepted this canon judgment, etc. So for future, government has said only the jurisdictional officer has the power. Others can investigate, but cannot issue show cause notice or adjudicate the case. Apart from that, government wants to have a faceless assessment in customs. That's already there. Now, from a legislative standpoint, jurisdictionally, they have given a concurrent jurisdiction so that the CBIC can give powers for having a concurrent jurisdiction on a faceless assessment basis. Apart from that, one important change in customs, which will be relevant, is for all the advanced rulings. Advanced rulings provided certainty of the transaction because it was binding on the tax officers also as well as the taxpayers. Now they've given, and it was time immemorial until unless there is change in facts or law. Now they have given a shelf life, even if there is no change in facts or law, they have given a shelf life of 3 years. After 3 years, that advanced ruling is not valid. The moot question comes in. Moot question is, what happens after 3 years? Should I go for another advanced ruling? Should I take whatever position I want to take? What do I do? So government doesn't want to be bound time immemorial if they feel that advanced ruling would maybe on the wrong premise and they have not challenged it. They don't want to get stuck with it. So that's the new provision. So it will be only for a 3-year shelf life, and then you can take your own position. We'll have to see how law develops in this front and how the taxpayers' positions are taken. Apart from that, from a valuation point of view, customs valuation, the government is given more powers to Central Board of Indirect Tax and Customs to provide mechanisms and to call for data obligations on the importers, so that when they import, to check on valuation. This will certainly have a negative impact in terms of ease of clearance, ease of doing business, because the CBIC may have more stringent and more requirements, more compliances that we'll have to undertake to the importer at the end of the importer's sign. Apart from that, whatever the data that you provide to the customs authorities are, confidentiality has been recognized, and they have said that if that data gets, unauthorized publication of this data is punishable with imprisonment and fine. Then for end-use based exemptions, government is trying to make it more simpler. It's a trade facilitation measures to make it more simpler and through more digital and transparent. And then other than that, a benefit duty-free import scheme for end-use based criteria for certain sectors like handicraft, textile, leather, garment, leather footwears, etc. They've given that, you can import and, duty-free, and then if you export, then you will, so it's more of a cash flow impact. You're not required to pay the tax when you import it will be duty-free. So this is the exemption that they have brought out. Apart from that, the hallmark of the customs changes has been Atmanirbhar Bharat or Make in India. They want India to be a manufacturing hub. The idea is simple, and this since 2014, since the government has come in, we want, if India is a bigger market for everyone, then please manufacture in India and sell it in India. Otherwise, pay customs duty. So that's how they've been increasing customs duty on various products. Even in this budget, they have rationalized customs duty, wherein they've increased customs duty for a lot of products which they want to be manufactured in India, and some of the products they have reduced it, say raw material, etc., so that people are encouraged to import raw materials and manufacture in India. Apart from that, they have also pruned. They are also, it was always customs, deriving a customs actual effective rate was a challenge, because you have to look at first the tariff. Tariff provided a general rate, then you have to see the exemption, general exemption to identify what the rate. It was becoming more complex. They are now trying to simplify it by adding the effective customs rate in the tariff itself, and so which will come from 1st May 2022. Apart from that, as I said, from a Make in India point of view, project imports, which was for high value projects, there was a concession or exemption given, which they'll be phasing out, and it will attract 7.5% in phased manner. So that's one of the change again for manufacturing India. Even those projects, what are equipments needed, you need to manufacture in India. That's the message the government wants to give. These are the key changes in some the rates, which I am not going in detail. Maybe it can be referred later on. Special economic zones. Probably government has realized that now, because states are also there, it will be needed both center and state come together to have the SEZ, because SEZs rolled out, or the mechanisms of SEZ being implemented, so that there are benefits given by both the governments, and maybe encouraged with GST. The marriage has been going on since almost 5 years. So government wants state partnership to be there. So SEZ law will be revamped with development of enterprise and service hubs. Let's see how it happens. That's the announcement that was made. And from a customs standpoint, SEZ will be automated for SEZ for making their life easier for facilitation purposes. SEZ would be automated functions on the customs national portal for whatever the dealing of SEZ and customs authorities are needed, and only risk-based checks will be there. That's it. Excise, they want a blend for green fuel or green footprint. They want a higher rate of 2% of excise duty per petrol and diesel. That's been increased from 1st October 2022 for unblended months. That's it from indirect tax perspective. We can happy to take any questions.
Thank you, Malik and Saket, for your presentation. We now invite the listeners to type your questions in the question box for our speakers to answer.
There are already a few questions that are already there in the question box, and maybe a couple of questions that come at the time of registration. So I'll take up those questions, and maybe Radhika, Saket, you can help me with the respective parts. So I think there's first question for Radhika. Radhika, the question is that how do you see the debt level, be it at a central level or state level? Are we in debt, interest, inflation spiral?
Thank you so much, Malik. I think certainly an interesting thing, an important thing to watch, because between the center and state put together, everyone who's looking at your fiscal math, we don't necessarily look at only the center that provides only half the picture. So in terms of the fiscal deficit at a general government level, which is essentially state and center, it is at upwards of 10% of GDP still, right? So that's very significant. And if you look at the debt levels, it's at closer to 90% of GDP, again, extremely high. And if you were to, generally compare with any of the other emerging markets who have also undergone fiscal stress in the past 2-3 years, their debt levels have also gone up, but amongst them still 90%, our debt levels are significantly higher. So it becomes important, therefore, to get a path to lower the fiscal deficit and the path to lower debt levels as well, on a sustainable basis. And we should also remember that sometimes this is also a function of how fast we grow and at what cost we raise money, right? So for example, last year or the year we are in fiscal 22, borrowing costs were low, nominal GDP was very strong. Going forward, the reverse might happen where nominal GDP begins to moderate, and you will see borrowing costs go up. So that spread kind of turns against us, which means that interest payments are going to increase in terms of costing, and also there are more debt which is coming due, which suggests overall that our debt levels will not come down in a hurry. So at this point, it is already quite high, and I think we need a path to bring it down. I wouldn't say we are in a debt inflation spiral, so to speak, but certainly we need a path to bring down both indexes. To some extent, it's interlinked as well. So I think unequivocally it is important to bring the overall debt levels down, simply because the starting point that we had before the pandemic, and it has risen since, leaves us among the highest amongst the emerging markets or the developing world whom we compare ourselves with usually.
Right. Thank you so much, Radhika. There's another one for you. Specific. It's not mention your name, but I'll put it up to you only. Okay. How much can we rate the current budget move towards the top economy as compared to the earlier years. What should they have done better this time?
I think the budget has taken the necessary direction, or what is preferable, right? Usually you would gauge any budget or any government's presentation based on where is the bias for the measures. Is it more just going populist? And I think for this year's budget in particular, because we are at the brink of going into state elections, there was an expectation it's going to be, perhaps from some quarters, it's going to be populist. And now that didn't really happen. Instead, they've gone down the supply route. And I think that's, again, something new that's happened in the past 2-3 years, where they're trying to be more supply oriented in terms of reforms, in terms of capex spending, and not be too spending driven, by giving cash per se. So I think the ingredients are there, right? But again, the government can only play part of the role. What they're doing is hand-holding to a certain extent, but they do require and count on the private sector to come on board. So I don't think single-handedly the government can turn the fortunes around. They're certainly playing a very supportive role, but they also require private sector participation. And the private sector, again, is looking at a completely different set of variables. The policy uncertainty, not only locally, globally as well. They're also looking at demand visibility, external domestic market. So those chips need to fall into place for the private sector to also participate. So I would think, to answer the question, I think the ingredients are there, but you need more parts to fall into place as well to take us to, say, for example, the 5 trillion goal that we have.
Right. No, I think that's very valid, Radhika. In fact, for me, I thought the budget was I would rate it much higher, purely on 2 counts: that they have maintained consistency, which, unlike any other government in the past, I saw actually a consistency going on through the budget. And second, not giving into the temptation of making a populist budget, given that mother of all elections are going to be in this year. But yeah, I think that was it. There's another question, and I'll take that up. It's on the digital virtual assets. Are they covering the regular software or software-related IPI in digital virtual assets? Well, the definition of digital virtual assets has been very, very wide, right? It's difficult to comprehend the entire definition. It's a very technical and complex one. But I don't think so they are covering the software and software-related IPI. They also have kind of very categorically mentioned that the idea is not to cover what is already been taxed in the normal sense. And they also kept the powers at the government level to notify certain things that are, if by mistake, getting included in the definition, to exclude that specifically. So I think the thought process from the government is clear, that they want to what they want to tax is only assets like cryptocurrency, NFTs, and those kind of things, which are not really, there is no code or no taxation available right now, but the normal sense of software, etc., are not getting covered. There's one for Saket. Saket, the question is that GST department ready with GSTR 2B? Shall we safely assume that credit, if available, or if an invoice in ITC is recorded on GSTR 2B?
So from GST standpoint, GSTR 2B was already available since maybe, I think, a year or so. It was not given any legislative powers or legislative recognition in that sense. Only from 1st January, effective from 1st January, we had already notification was issued that GSTR 2B would be now the basis for taking the credit. So it was already there. Whether it's accurate, so the department is anyway ready, because that report is ready since last 1 year and it's been notified since from 1st January. Only thing that this budget has done is there are additional criteria that have been included in the GSTR 2B returns. The section that I mentioned, my vendors, the GST 2B return will provide if the vendor has defaulted in other parameters also, which are newly introduced. We'll have to see what the rules comes out, how the rules comes out, and how that get implemented. These additional criteria gets implemented in GSTR 2B return. And once we have the GSTR 2B return, probably we could say that this is the credit, this is the ultimate amount of credit, because it would have got filtered across various, all the filters should be applied. We'll have to just see how GSTN technologically applies this filter over such a vast population that we have, or such a vast taxpayer base that we have. How are they applied to do it, and how accurately technologically it is. Those are the things we'll have to watch given the additional criteria. Otherwise, GSTR to be return was fine. Since last 1 year it was being done for people to look at it. It was already there. So we'll have to see with the additional checks how the GSTR to be comes out.
Right. I think we have one, we have already overshot the time, but one last question I have temptation to bring in Radhika again here. The question is that Radhika, the spending are almost same as compared to the previous year. Considering inflation, can you actually say that the spending has decreased? So this is the last question that we take up, Radhika.
Sure. If I get the drift of the question correctly, I'm not sure if it's trying to ask if this spending is inflationary. I'm not sure if I'm interpreting it right. But if that's the drift of the question, usually what you do see is that a budget or a fiscal policy that tends to go to carry heavy demand impulses in the very short term tends to be more inflationary. I mean, a very good example is what happened in the US, right? So the economy was already recovering. The latest bout of fiscal stimulus, which put more money in the hands of households, I think aggravated the pickup in inflation and which they're facing, in addition to what's happening on the commodity space. So I would think if that's the rationale that we use, because usually what does a central bank worry about? What price concern starts from a supply side quickly turn into a demand side, right? So they're always worried about the generalization of inflation, worried about it becoming a demand and wage problem. So from that perspective, I wouldn't think that the budget is necessarily inflationary. There could be inflationary impulses because you want higher infra, higher capex. Your demand for those ingredients go up, and if some of that is imported, then that can be translated into price pressures as well. But it's a very slow moving train. So I wouldn't necessarily think that this budget is inflationary. I'm not sure if the question tried to ask if that is feeding into nominal GDP or something, but this is the interpretation I draw. So I don't think it's necessarily inflationary. So for the central bank, for instance, when they meet next week, they would be bothered about the bigger borrowing program and how they're going to handle that in the light of existing issues, which is, globally and locally inflation and all of that.
Right. Thank you so much, Radhika. Simran, over to you.
Thank you so much. I would really like to thank our speakers today, Radhika, Maulik, Saket. Thank you so much. I'm sure our listeners too found, your entire presentation and the answers to the questions very relevant and insightful. If there are any other questions in line with our discussion today that we were unable to address due to the time constraints, we welcome you to reach out to us at thinknext@nexttime.com, and our team would happily respond to you offline. We welcome your feedback on today's presentation. Stay safe. Thank you and goodbye.
Thank you, everyone.